Hello, everyone. We're going to talk about climate cycles and catastrophe concentrations with two excellent speakers. So Paul Wilson from Securis Investment Partners and Marc Lehmann from Howden. If you want to come and join me. So Paul is running the climate and catastrophe research team at Securis Investment Partners, who was founded in 2005. It's an ILS asset manager based in London, managing more than 3 billion assets. And Marc is leading the climate risk and resilience division at Howden, launched in 2021. That aims to help clients transition to a low-carbon economy and mitigate climate change impacts. It offers services including credit insurance for renewable energy projects, parametric insurance for disaster relief, and carbon credit protection. I hope I got it right. Yes. Perfect. Maybe, Paul, we can start with the first question. So, Hurricane Beryl was the first Category 5 hurricane on record that happened in June. So the season is well upon us. So what do you see for the upcoming season?
Yeah, thank you. So yeah, I think we are sadly coming to the end of the sort of little bit of a lull in activity that's sort of fairly common in July around. Typically, July is a time of the year when you'd expect to get lots of these Saharan dust outbreaks, which kind of suppress activity during the early part of the season. But the expectation, this isn't me, I'm not a meteorologist by training, so to speak, but most of the commentary and most of the people that I follow and track are sort of expecting that in the next few weeks, the activity in the season will pick up again. I think Beryl is a really good example of kind of what this season is going to be looking like. The way I've been thinking about Beryl, in particular the storm, is that it is an exceptional event from a climatological perspective, but in no way unexpected, given the sort of sea surface temperatures that we're looking at, the ocean heat content, particularly around that sort of Caribbean Sea region. And I think that really speaks to the way that we at Securis have been working with Reask, but also sort of thinking about our view of risk. It's moving from that idea of a sort of much more static view of catastrophe risk to something which is far more dynamic, far more about tracking how things are evolving, far more about monitoring the state of the climate system and basing our view of risk and basing our decisions on the current state of that climate system. So that's really the way we're thinking about it. But yeah, I think as everybody has probably seen in terms of the forecast that's been coming out at the start of the season, this is going to be a very, very active season. I would say that some of that expectations may be moderated a little bit. It's not quite as extreme as it was we were thinking of back in May and such, but nevertheless, this is going to be an eventful summer, I feel.
Yeah, it's going to keep our research team busy this summer, even from their holiday location. Marc, you are more working with large asset manager and risk managers at large corporates. What do your client need in regard to climate support and dynamic view of risk?
Yeah, so it's slightly different on our side. Just to put in context, Howden has created a sort of climate risk and resilience team about three or 4 years ago. And the way that's structured is that we have an advisory unit that covers physical climate risk, transition risk, and climate liability risks. And then alongside that, we have a transactional team who may take some of the insights from that advisory to create risk transfer products aligned with climate solutions, so perhaps parametrics and things like that. So that's kind of how we're set up. Personally, I lead the physical climate risk advisory. And so you mentioned sort of asset managers. We're dealing largely with people looking to get insured, so corporates, and those corporates could be financial services, they could be non-financial services clients. On the non-financial services side, it tends to be multinational manufacturing companies, manufacturing different products. It could be transport, logistics, and so forth. On the financial services side, it would be less the owner-operator, but more the people investing in assets. But in those two categories, we're looking a little longer term. So more than a year out, we're looking 5, 10, in some cases to 2050. The business planning horizon is using sort of climate analytics to help people understand their current risk, so it's a baseline risk profile, but also how does, say, for example, flood risk change in Europe for my portfolio of assets in the next 10 years or next 12 years? Could that risk come down? Could that risk increase? And often associated with the cost of insurance, potentially having foresight on increased premiums, or is there risk and opportunity in those kind of things? So it's a different conversation, but often over a longer time horizon, and it can be insurance related, or it can be helping to address climate disclosure reporting, things like TCFD, CSRD, or EU taxonomy in the sort of investment community. But generally speaking, identification of risk and helping to quantify that longer term.
And do you see more requests from your client on more granularity on the model, or like maybe having a model that is not so much a black box and be able to analyze alternative climate scenarios?
Yeah, it's an interesting question. Different clients, different sort of levels of sophistication, different stakeholders. So on the one hand, you might be speaking to a risk manager, head of insurance. On the other, you might be speaking to the head of treasury. Might be a medium or a large size company. Within the sort of asset management space, investment, sometimes they are looking for a tech-enabled solution where they can access a tool and run their own analysis. In some cases, it can be a consultative service they're looking for, where it's not just delivering insights, but it's helping answer investor questions sort of around the outputs. So it can vary. On the data, as we all know, it depends on the peril, particularly localized perils like flood, so river flood, flash flood, and surge. It's what we do quite a bit at Howden is understanding who's out there in the market, who's providing the different sort of data sources, what's the resolution, what's the sort of methodologies, and so that we can understand, where to draw on in terms of data for the specific use case.
Thank you. Yeah, and for you, Paul, it's a bit different, right? You have to answer to a lot of investors' questions. So what degree of granularity do investors require in this dynamic view of risk?
I think it's definitely evolving, and it's something that we have been working very hard to make sure that we can respond meaningfully to the questions which we're being asked for our investor base. So we are at heart an asset manager. We're not an insurer, we're not a reinsurer. And that mindset of working for a set of investors who have every right to ask the question, as you are moving into the start of the hurricane season, and we talk a lot about hurricane risk because it is our sort of peak peril, they are seeing the public forecasts. They are seeing the information coming out of CSU and tropical storm risk. They are seeing that expectation, that media-built expectation of what the season is going to look like. And they have every right to turn around to Securis and say, what's the risk profile look like now? How does this expectation for this upcoming season inform my investment? What should I be thinking of in terms of future subscriptions, future redemptions? Those kind of questions, they can do those kind of things on the timescales of the hurricane season. So we need to be in a position to be able to answer those questions, and we need the tools that can kind of map out how the current state of the climate and that forecasted state of the climate into the next few months is going to inform somebody's investment decisions. So we need to make sure that we have the tools that can kind of respond to that. And that's been a very big part of how we've been thinking about framing our view of risk, building it into a more dynamic framework, but also building in additional sort of layers of insight into the investment decision. So when we make investment decisions, say at the start of the renewal season or pre the start of the year, that sort of traditional 1/1 reinsurance renewal cycle, we want to be in a position not just to look at, say, a core traditional vendor provided view, a sort of transactional view of risk, which may come from the RMS or the AIRs of the world, or Verisk and Moody's. But we also want to be able to answer the question, say, given that we are transitioning into a state of La Nina, or that's expected to be transitioning into that state over the summer, how is that state going to inform the risk profile of this investment? How sensitive is this investment to those kind of climate conditions compared to a different investment that may have a very similar risk profile to the sort of general climate, but maybe far more sensitive to any of those particular specific climate states. So building a toolbox that can kind of address that has been very, very important to how we've wanted to think about not only managing our risk in real time during the course of the season, but also making investment decisions prior to the start of the year.
And so you see the need for enhanced risk models accounting for climate conditions, really, like in both of your practices?
Yes, I think so. I mean, for us, particularly the climate conditioned view, if you take a climate condition cat model or you take a climate model and you downscale, I think there's more need. It really, for us, often depends on the use case. There's so many different categories and situations. One example recently was one investing in utility infrastructure in the Caribbean. And that was part of a due diligence exercise pre-acquisition. And it was really simply running a climate analysis across the key assets, the power stations, utilities, the transmission lines, to give a current day view of risk, feeds into the investment process. But then we realized actually after post-acquisition, during the whole period of an investment, there can be some climate adaptation solutions of interest to an investor to undertake during that whole period, say 10 years. So it becomes an attractive risk later when they come to sell. So there's lots of different sort of situations you can think about. And on the climate adaptation side, I think worth mentioning the importance of engineering and particularly for single assets, single risks, high exposed, high values, where in some cases desktop models may or may not be the right solution, is having that sort of climate, what we call climate risk engineering. It's kind of like a fancy new term, but it's basically catastrophe risk engineering, being able to go on site, do a real in-depth vulnerability assessment against flood or wind, and come back with a more informed view on the loss potential today, but in the future, but also what investors or owners can do to mitigate future risk. So how can you spend in climate adaptation? Climate adaptation is becoming more and more important as insurance can sometimes be limited or reduce. How can you otherwise build resilience into those assets?
Yeah, I suppose this is important to have like granular and climate conditions models to approach these problems. And actually, yeah, considering these new model developments like Reask, for example, and hurricane risk, what are the gaps and opportunities you still see in the current market?
Maybe the thing I can say is that one of the things that Reask has given Securis is that ability to continue to use the existing vendor solutions, which we rely on super heavily, we value what they do and what they've provided to the market in terms of that transactional view, but dramatically increase the flexibility, dramatically increase that flexibility to explore different states of climate, to look at different time horizons, though that kind of expanded toolbox. But at the moment, it's pretty restricted to US hurricane, effectively. And expanding that out to other perils in other regions is something that we need to build some internal capacities around as well, but we would definitely like to see an increased toolbox around that.
Thank you.
Yeah, I would just add, to flexibility, I think we always assume a static balance sheet in future climate. I know it's not easy. I mean, the key driver is change in hazard, which we model quite well, Reask, many others. But in reality, in 10 years' time, the exposure is going to look different. The vulnerability is going to change because of modifications to structures and so forth. So it's a challenge to really simulate reality as close as possible. So that's one thing around sort of dynamic balance sheet and vulnerability. But the other thing is also cascading effects and the whole macroeconomic influences around climate. So we tend to look at account by account or client by client and sort of blocking out all the sort of world issues over the top of that and the macroeconomic impacts, which can change the results quite significantly. So how do you capture? There's quite a few people doing that, but it's not that easy.
Plenty of work for the future then beyond hazard modeling, yeah.
And I think, models are tools to help give estimates. they inform decisions, and it's how appropriate those models are for the specific use case.
Thank you. I think we're just right on time. No chance for burning questions. But I'll give the mic back to Matthew. Yeah, thank you.